And then also recognize Scott Moore. He's Koga's chairman of the board and VP of marketing for Anadarko. Thanks for your leadership, Scott, of the organization, and all the hard work that you've done this year. It really shows. Thank you very much. Let's give these folks a round of applause. So this is our 11th year for the Investment Forum, and this is the first year that I've had the privilege and honor to serve as chairman. And one lesson that I learned over the past year serving on Koga's conference steering committee, that you shouldn't miss a meeting, because if you miss a meeting, you'll come back, you'll find yourself chairing a conference or a forum or something, and some such lead role. But honestly, though, it has been a lot of fun assembling what I believe is a group of world-class executives that are leaders in our industry that'll discuss over the next couple of days the exciting world of unconventional plays across North America. Each panelist will discuss their company's long-term commitments for capital and the need to develop talent as we face so many challenges to unlock this tremendous resource. So here's the format. We'll have 3 panels. The unconventional oil panel number 1 is this afternoon, followed by our keynote investment forum speaker, Dan Pickering, tomorrow at 1:15, which will in turn launch the second unconventional oil panel. And then finally then the E&P services panel, which I'll be moderating at 3:15 tomorrow afternoon. And then essentially our structure consists of each panelist spending a few minutes on their company story prior to discussion, questions, and answers as a panel. So with that, I would like to introduce to you our moderator for the first unconventional oil panel, Peter D. Peter is the president and CEO of Cirque Resources, based here in Denver. And then also, please refer to a little more detailed bio in your program. But Peter and I are very good friends, and we shared a past life together when we were at Barrett Resources. And the one thing that I like to mention to people when who do not know Peter is that he loves the extreme. Whether it's a 3-week trek to Nepal to view Mount Everest at about 18,000 feet, or whether it's a 30-day traverse into Canada's highest peak, Mount Logan, or whether it's a 42-day expedition across Anwar, trekking across Labrador, climbing Denali, you get the picture, you name it, he's done it. So with that, please welcome Peter D.
Well, thank you, Ted. I was going to say I was happy to be here, but you just reminded me of what I'm missing out on. Thanks, Ted, also for your organization of all of these panels, and including ours. I'm going to introduce our esteemed executives as we go through here, but suffice to say we had 2 that were smart enough to escape the Texas heat and drought. Scott told me that Houston's, or I guess Dallas, is on day 31 of a 100-day heat spell, and they look like they may unfortunately be breaking the 42-day record of above 100. Jim Fraser, who you'll see here in a short while, he was smart enough to leave Calgary, come through Denver, get a little warmed up before he goes to Houston, just so he can go back to Calgary and really appreciate he lives in the far north. And Jim Kleckner is just glad he didn't have to go anywhere to speak on a panel for a change. So, because I know he travels quite a bit. Well, our first guest speaker here today will be Brad Fisher. He's the Executive Vice President and Chief Operating Officer for Carrizo, which has been a rapidly growing resource company, both in the shale gas and now in some of these tight oil plays, formerly with Cody Energy and Ultramar. So, Brad, thanks for kicking it off for us.
Good afternoon. I was told I have about 5 minutes or so. That translates into 15 for me. So we'll skip by the forward-looking statements here. This slide shows the location of Carrizo's oil and gas properties. All our current activities, with the exception of our North Sea property, are focused on developing resource plays above 10,000 feet. This allows us to stay with a pretty consistent drilling rig package that we can move around from place to place and keeps us away from exotic proppants and exotic completion techniques, which cost extra money. We currently produce about 120 million a day, with 100 million of that coming from our core Barnett asset, 10 million coming from our Gulf Coast, legacy Gulf Coast properties, and we have about 1,500 barrel oil a day equivalent coming from our new entry into the Niobrara and Eagle Ford Shale plays. That split right now is about 1,200 barrel oil per day and 2,200 MCF of gas per day. From the activity side, we have about 8 rigs running. We have 4 in our Marcellus Shale project, where we expect to start a full-scale frac program later in the fourth quarter this year. We have 3 rigs running in the Eagle Ford Shale. We expect to drill 22 to 25 gross wells this year, and we have 1 rig running in the Niobrara Shale. For the balance of the year, we expect to drill about 10 to 12 wells there. We also have a dedicated frac crew in the Barnett Shale, which continues to drill up our inventory of about 25 wells that we've garnered over the last few years with our activity. Last but not least is our North Sea Huntington project. That project has finally entered the development drilling phase. We expect that to come online first or second quarter of 2012 and net about 4,500 barrels of oil a day net to Carrizo. Our strategy since our inception in 1993 has been organic growth through the drill bit. We've grown our entire resource position on the backbone of our Barnett Shale play that we entered into in 2004. As a company, we excel at organic growth through taking leases, application of 3D seismic, and horizontal drilling. Riding the oil to gas valuation differential in 2010, we made a conscious shift towards resource plays prone to oil. In that short time, we've acquired about 95,000 acres in the Niobrara and the Eagle Ford plays. We've put 4 rigs to work in those plays, added 1,500 barrel of oil per day equivalent to our portfolio, with our target being to exit the year at about 5,000 additional barrels of oil per day. That goal will increase our production about 18%, but because of that strong differential between oil and gas, that'll add 47% to our revenue base. This table summarizes the reserve potential of our liquids plays. This is the same methodology we've used in the past to show the value of our Barnett Shale acreage. What we do is we start with acreage, we discount it for drillability. Drillability includes things like 3D seismic, lease geometry, and geologic prospectivity. We generally consider the Eagle Ford Shale at this point as a less risky reservoir. It's pretty evenly spread across our acreage position. The acreage assignment that we've made of 115 acres is based on 5,000-foot laterals with 1,000 feet between well spacing. Our position, we believe, will support 230 wells and reserves of 92 million barrels of oil. The Niobrara is a bit more variable across our acreage position. We still don't have all our 3D in, and this is going to result in a lower drillability factor for us. But based on the success of some of our first wells, this 50% we're currently using may be a little bit conservative. Right now, at 320 acre spacing, we feel like we've got 100 locations, which result in just under 30 million barrels of oil potential. We feel the Niobrara has additional upside to increase that drillability factor, as well as 160 acre potential downspacing, which the microseismic has indicated may be necessary due to poor lateral frac extension. This slide here shows our Eagle Ford Shale position. There's a lot going on here. As you move from the southwest to the southeast to the northwest, the changes from red to green to dark green represents the transition of the play from the gas window to the oil window. The black lines are depth contours. Depth generally decreases as you move to the northwest. The multicolored lines are pipelines, and the yellow is Carrizo's acreage position. The stars are the wells we've drilled to date. When we entered the Eagle Ford play, we focused our leasing in the gas condensate window above 10,000 feet. Once again, this was an economic decision to stay away from exotic proppants and completions, which improves the economics. The reserves that we see in the gas condensate window are about 80% liquids, and we're taking advantage of the strong differential between oil and gas pricing. And from a reservoir engineering standpoint, we feel like there's enough gas here to efficiently get the liquids out of the ground. To date, we've drilled 15 wells with 3 additional wells in progress. We've got 5 online, all testing at or above our expectation. at rates between 700 and 1,000 barrels of oil per day. We've got 3 flowing back after frac, and we have 7 waiting on completion, which we expect to start here this month under a new term agreement we signed with Halliburton for a frac crew for 22 months. This slide is simply compares our well reserves in the Eagle Ford to published estimates for other companies that work around us. Our current view of 400,000 barrels of oil equivalent per well is in line with industry expectations. These are our economics for our 400,000 barrel equivalent oil well. Our type curve, we assume 750 barrels of oil per day. That's an average of 590 barrels of oil per day for the first month. The production graph on the right represents wellhead volumes for oil production and process volumes for NGLs and residue gas. Our CapEx is based on $7 million in these economics, 5,000-foot laterals with 18 to 20 fracs. Right now, we're actually seeing well costs more in the range of about $8 million, and that's basically most of the wells are incurring kind of first of unit, first of pad. We have things like reserve frac pits, gathering systems, that type of thing charged to those wells. We really like the economics of the gas condensate window. Once again, with over 80% of the revenue stream associated with liquid, we're taking advantage of that oil price differential. The production rates are strong. We produce about half of our reserves out of the well in about 2 years from the start of production. And at current market prices, we're seeing north of 70% rate of return. One of the value components of the Eagle Ford Shale is the processing component. The value of the associated gas in the condensate window is significant. Without going through all the math, this is a bit of a complicated chart, but basically when we produce one barrel of oil, we have 2,000 with a 2,000 GOR, we generate about a 1.33 barrel of oil equivalent. The value added from processing that gas ends up with 1.3 MCF of residual gas and about a quarter barrel of NGL liquids. And you can see down in the lower left, this adds about $18 a barrel, or at $100 oil, 18% to the value per barrel of oil produced. The next page is our activity map for our Niobrara. It's a similar map here to what I showed in the Eagle Ford, highlighting Carrizo acreage in yellow, wells drilled, and 3D outlines. The Niobrara is quite a different play. We're calling it a bit of a hybrid. It exists everywhere on the map here. It is self-sourcing, but it's not productive everywhere. We entered this play with very specific target areas to lease versus the county-wide programs that are typically associated with shale plays. Leasing was based on subsurface mapping of resistivity and porosity trends from numerous deep tests that departed from Wattenberg to the southwest and Silo to the northwest. To date, we've acquired 62,000 acres. We like our neighborhood. Noble's reporting some good results out of Wattenberg, and EOG just in the northwest of us, who we think knows the most about the play, has reported some very good results. To date, our results have been good. We've drilled 6 wells, completed 3, and we're systematically improving the performance of each well. From an economic standpoint, we use 300,000 barrels of oil equivalent per well. Our economics assume a $3.6 million well, 4,500 to 5,000 foot laterals, 320 acre spacing, and 18 to 21 frac stages. Our type curve, shown on the right, assumes a 500 barrel oil per day initial rate and average of 354 barrels of oil for the first month. We use a GOR of about 1,200, and 40% of our reserves are produced in the first 2 years. The Niobrara yields exceptional returns based on these assumptions. Today's price is about 146%. We do feel, however, that there's going to be more statistical variability in the performance of the Eagle Ford just based on our geologic model. And in summary, we successfully levered our Barnett experience into the other shale plays in both liquids and gas opportunities, and we're well on our way to adding significant value through our liquids-rich plays. Thank you.